We have something called your ratios, and then we have relaxed ratios depending on if your credit score is above 680 or not. So if your credit score is above 680, then most lenders are going to allow you to use those relaxed ratios, which are going to be 39 and 44%. You're going to see the banks and financial institutions really looking at the applicant as a person. So they're going to look at your personal net worth statements, your experience owning that type of real estate. They're going to look at your credit. They're going to look at if you own any other property. And then they're also going to take a look at the
And so talking about residential mortgages, you know, those of us that have done a few of those, we're familiar with some of those ratios, right? You got your GDS, your total debt service ratio. Do you guys mind breaking down for us exactly residential and commercial, what ratios are important and what should we be looking out for?
Yeah, so do you want to take that? Or?
Yeah, I can take that. So obviously those ratios are dependent specifically on your credit score. So we have something called your ratios, and then we have relaxed ratios depending on if your credit score is above 680 or not. So if your credit score is above 680, then most lenders are going to allow you to use those relaxed ratios, which are going to be 39 and 44%. That's 39% of your gross annual household income and 44% of your gross annual household income. So just a little bit of background on what GDS and TDS are real quick. Gross debt service ratio is all the costs associated with your home purchase. So it's going to be your property taxes, your mortgage payments, and your heat allowance. We usually use about $150 a month for heat allowance. We figure out what all those costs are, and then we basically divide it by your gross annual income. And then your total debt service is basically the same thing except outside debts as well. So your car payment, your student loan payments, your line of credit payments, all of those are allowed to equal 44%. Now, if you fall within those specific parameters, you're good for an A mortgage. If you fall kind of outside of those parameters, there are other lenders that have the ability to be able to help you qualify, but under different parameters with maybe a cost associated with it.
Gotcha.
Yeah.
And then when we're moving into commercial, are there ratios we need to worry about? Are they the same ratios? What's up there?
Yeah, so I think it's important to realize that once you start getting into commercial lending, it's almost as a per case basis. So you're going to see the banks and financial institutions really looking at the applicant as a person. So they're going to look at your personal net worth statements, your experience owning that type of real estate. They're going to look at your credit. They're going to look at if you own any other property. And then they're also going to take a look at the property in general as well. What's the cash flow? Does a debt service coverage ratio cover 1 to 1.2? What is the economic lifespan of that property? Do you have the money to be able to cover any costs associated with that property? So it's a lot more than just filling in and checking those boxes. It has a lot to do with, can you support the payments for that property, and do they trust you as a real estate investor to be able to buy that property?
Gotcha. And so one thing I often hear newer investors parrot, but I don't think they actually understand what they're saying, is, oh, when you're getting into commercial, they only look at the building. And I think that there's rumors out there with a lot of investors that the moment you break into that 7+ units, that all of a sudden you don't matter at all. Do you guys mind touching upon that a bit? Because personally, based upon my experience, that doesn't seem to always be the case.
Yeah, I'd say it's almost the opposite. You know, once you start to get into that 7+ unit and, you know, you enter that true commercial space, it really comes down to how much history do you have in that respective field. You know, if you're looking at maybe building some larger 10+ unit, 10 to 12 plexes, if you are truly building it from the scratch, when we take your application and we go to find you funding, the first thing a lender is going to want to know is, you know, how many projects has this guy done in the past? Mm-hmm. Does he have any experience? You know, who's doing the building? Is it him? Is he hiring a contractor? You know, it really does come down to a lot more of the person who's on the application. They are going to take a look into the debt service coverage ratio. So as Josh said, when they take a look at the finances, they are going to want to see that DSCR come out between 1.1 and 1.2 generally to begin with. But yeah, it moves away from your standard GDS, TDS ratios, and it moves into a lot more of your personal portfolio, what you've done in the past, and what you're bringing to the table. How much skin do you have in the game? You know, did you pick the property up dirt cheap on a power of sale and maybe you don't have as much invested in it versus someone who has serviced the land themselves, bought the land themselves, and maybe they have a few million invested into the project, that person is less likely to walk away than to someone who has gifted land or picked it up for dirt cheap, right? So that becomes a risk to the lender as well too when they're taking a look at the profile.
Yeah, I think it's also important to really realize that banks and financial institutions try to mitigate the risks. So they want to know that you have the capacity to pay that loan. At the end of the day, you need to pay that loan. So their job is to make sure that you have that capacity to do that. So that's why it's not just checking boxes anymore. It's you as a person, do I trust you at the end of the day to make that payment?
Yeah. And one other thing we can touch on quick is when you start getting into those residential units outside of like a multifamily, and perhaps you're moving into more of the actual commercial space, so you're renting out to a business, something that we call an anchor tenant can make a really big difference as well too. Is it someone who's just starting a supplement company, it's their own brand and they've never done this before, and they may go out of business within the first 6 months? Or is it a government regulated building like an LCBO or something that has a history of being a profitable business, is going to be coming in with the support of the government? They're going to look at the strength of that, and that's going to come into play as well too.
Right. So when we're talking about an anchor tenant, we can kind of picture your stereotypical strip mall, and you got like the big grocery store on the end. That's kind of your anchor tenant, and then you've got a bunch of smaller stores. Yep. So having that one big anchor tenant is a big deal when it comes to commercial versus the strip mall that only has small shops.
Yeah, absolutely.
As we get into our conversation about how we derive value, those anchor tenants really affect the cap rate on that commercial unit, which is going to affect the total value of the property in general. So that anchor tenant is almost the most important part of your development or of your strip mall, for example, because once you can verify that that income that you're deriving from that stream is guaranteed, the value of that property substantially goes up.
Because we're lowering our risk, right?
Exactly. Yeah.
Gotcha.